What the world wants.
Hello and welcome to this very special show, What the World Wants. And this time we're talking about what the world wants from the union budget that is upon us. On the 1st of February, Nirmala Sitharaman, the Finance Minister of India, will present the union budget, and it's a tightrope walk that the government has this time around. On one hand, has to maintain fiscal prudence, and on the other hand, has to definitely pump prime demand after the country has been hit with 3 COVID waves. We have 2 gentlemen joining us now. First up, we have Caesar Maasry of Goldman Sachs, who joins in to give us his view. Caesar, thank you so much for being with us on CNBC-TV18, and Happy New Year to you. Before I ask you about the budget and the expectations, I was going through your report, and it's very interesting. You point out that the pattern of the last 5 years suggests that the outperformers of the last 5 years become the underperformers of the next 5 years. Can you contextualize that for us? What does this really mean from an Indian market standpoint?
This idea of rotation is indeed still a theme for 2022. We're hopefully coming out of the pandemic. We're moving from a period of very easy monetary policy into tightening rates, rising interest rates, and so on. So that is likely to lead to a number of changes across global markets. For EM, I really think the picture is quite a mixed bag, where some markets will do well, others maybe not. Because again, I think in general, the story is going to be one of generally slowing growth as the cycle matures and policy becoming a little bit more restrictive. So there still are opportunities, but I think overall, from an index level perspective, we're not looking at very strong returns for the balance of this year.
Okay, so when you say low returns for 2022, do you expect it across the board, across all markets? And where does India feature on the list?
Yes, thank you. So this indeed is an important risk for all global equity markets. Inflation currently is indeed a global story. Equity valuations across the world are fairly high, so higher rates could certainly threaten those valuations. I think there is a very important nuance here, however, in this particular hiking cycle or inflation period, in that emerging market central banks in general have started to tighten rates or tighten policy well ahead of the Fed, which again is not really the historical precedent. So the Fed has not raised rates just yet. We think they will do so about 4 times this year, but a number of EMs have already started to hike. In India in particular, we've not yet seen real rate hikes. Again, the central bank has perhaps moved off of some of the dovish language. We do expect repo rates will be hiked about 75 basis points this year. So in general, again, this is an important constraint to global equity returns. I think a number of EMs will be fairly buffered from this. I think one risk for India specifically, however, though, is indeed oil prices, which are rising very quickly, and that could pose some risks to higher rates, the need for further tightening of policy, and again, could just limit the upside we see in equities.
Oh, absolutely. I take that concern on board. I mean, oil prices are at a 7-year high now, and there are so many regional conflicts that you're seeing across the Middle East, so perhaps things could only get worse before they get better. But, you know, talking about valuations, I heard you briefly mention that valuations for a market like India are quite lofty. And in your report, you say that because of that, you prefer markets like Mexico and Russia. Just take us through that rationale.
Yes, that's certainly the most important reason, and I do think time horizon matters here. So, you know, the Indian equity market has come off a very strong run last year, certainly compared to emerging market peers, up something like 24%. But as you noted, the valuations of PE, the forward PE of the Nifty, for example, is something like 23 times forward earnings. That is the highest equity valuation across all of emerging markets. And so we see the opportunity in the near term, next couple of quarters perhaps, for some rotation into the cheaper or the less expensive EMs that have some room to recover. But again, I would importantly underscore, when we think about the 2 or 3 year sort of longer term story, the fundamentals on India look quite strong, and we would just look to re-engage at a better valuation entry point.
Okay, so the fundamentals of India look strong, but you're just saying that valuations are a bit lofty at the moment. The one thing that perhaps the street is going into the budget with is some expectations in terms of tax incentives, any kind of tax subsidies, any incentives, so that more money can be in the hands of a consumer that hasn't been spending for what, 3 years now. Do you think the government can do anything on that front?
Yes, so this is indeed an ongoing challenge, and what we've discussed, I think, over the years on this program. And I would say a couple of things. Again, firstly, the global context matters. Fiscal balances across the emerging world and even across the developed world have been pushed quite aggressively. So investor appetite, or I should say investor tolerance perhaps, is fairly high for fiscal deficits. That being said, the cycle is indeed maturing, and we expect the central government balance deficit to be something around 6% this year and gradually improving over the next couple of years. I believe the IMF has similar sort of figures. So that second derivative is quite important. I think investors will very much pay attention to which fiscal balances are improving, which of course at the same time is a result of growth. Now, one reason we remain somewhat optimistic here is there's only so much that policymakers can do. I think, of course, the course of the pandemic, and hopefully as restrictions are lifted and domestic demand picks up, we sort of get bailed out a little bit by strong growth dynamics, which is indeed part of our forecast for the Indian economy. So we remain fairly optimistic on this front. It is indeed a challenge for many EMs and for India to sort of manage, but we do think the path forward is a little bit brighter.
Okay, so coming back to my earlier question then, any tax incentives that you would expect at all? Because that would be a hard one, right? Given how constrained the government's finances are. What is your expectation there?
I don't have a particular view. Again, I think there's only so much that policymakers can do. In general, I would say with some of the tax, lowering of tax rate or tax incentives, of course, the markets tend to move higher on news like this. It's a sort of a market-friendly action in the very near term. But I think as you're intimating in the question, part of the challenge is here, well, of course, that might put some constraints on the fiscal side of things. The way we think about it from a broader perspective or from a strategy perspective is as cycles mature. So again, if we think the early cycle was basically from the middle of 2020 till, let's say, the end of last year, as the cycles mature, what we observe across emerging markets, both in the equities and in the currencies, is the countries with the most strained fiscal balances tend to underperform as that cycle matures. So again, the way I think about it is a headline story for markets to rally on in the near term. But again, when you compare India against some other EM peers, if the fiscal balance doesn't improve, that could actually lead to some underperformance over the course of this year.
Okay, let's now talk, Caesar, about some big themes that you like in 2022. And in your report, you mentioned that tourism, the return of tourism, is a big theme. I guess, that's quite obvious given how COVID cases are receding globally. But would you extend that theme into markets like India as well, tourism, hospitality, etc.?
Yes, I do think 2022 should bring back some of the travel and tourism industry, and perhaps more importantly, the pricing of that. So, the proverbial light at the end of the tunnel as we finally move, to the later stages, let's hope, of this pandemic. We observe that the sectors, the industries, the countries that are heavily reliant on travel and tourism have really just not recovered in terms of asset markets. And so we see, potential for those areas to outperform. In general, that's a little bit more some of the neighbors. So Southeast Asia, I would say in particular, but there are some sectors that apply more broadly to this theme in India as well.
Okay, since we're talking themes, there are many more that are playing out in India, right? There's the renewable energy, there's green technology, there's electric vehicles, there's this rapid digital adoption that we're seeing. So big tech companies are doing very well. Anything amidst this space that you like?
Yes. So again, I think there's a couple broad themes there and then some specific ones as well. Broadly, sort of new tech, also ESG, et cetera, is a very important theme. We see a lot of money being raised and a lot of interest from portfolio managers in these areas. So I would certainly say that is a theme that is likely to continue over the medium to long term. When it comes to India specifically, again, I think we have to look at valuation at different sectors and so on. So IT services, I mentioned the Nifty was up something like 24% over the last year. The IT services have pretty much doubled that return. So again, I think are fairly lofty in terms of the current entry point. Also, as we see the domestic economy recover and perhaps the currency stabilize, the IT service companies tend to actually underperform. So actually, as we start the year, our focus within India is a little bit more on domestic cyclicals, on the banks sector as well. And I would note that our economists have pointed to quite healthy tier one capital ratios across the bank balance sheets, and also fairly healthy corporate leverage. So again, I think going back to whether it's that value versus growth rotation or some of the domestically exposed areas, I think that's really the opportunity set as we begin this year.
Okay, you spoke about lofty valuations and why you would be cautious on markets like India. Is there anything in this budget that could make you change your view this time?
So again, the way I would contextualize our view is it's always relative to global themes and global markets. So again, with fairly high valuations to start the year, it's difficult to forecast or expect high absolute returns. But again, one way or one important aspect of the Indian equity market I would highlight is it's quite defensive, and the longer run story is quite secure. So it's in an odd way of saying, if there are further downside risks, let's say to the Chinese growth outlook, for example, if oil prices start to come down or stabilize, some of these external factors, I actually think that would make India more appealing as a core part of the portfolio, as a defensive position against some of the other markets that are swinging a little bit with a little bit more volatility. That's really how I would think about the allocation of India relative to the rest of emerging markets. And keep in mind, we are neutral on India, so it's a core part of the position. I wouldn't call our view particularly bearish at this point.
All right, so let's just wrap up then, Caesar, with your top 3 markets that you like this year in 2022, and what is your target for the Nifty?
Yes, so thank you. So firstly, again, just to contextualize, our MSCI EM target of 1,400, is up maybe 10% for the balance of this year. That's basically in line with what we forecast for the S&P 500. So, from a volatility or Sharpe ratio basis, not really expecting much emerging market outperformance as a starting point. I mentioned India as being neutral, particularly within the Asian context. Again, I still think India might outperform some of the CEMEA or LATAM peers. But if we had to pick 3 markets with some risks around them, China, we've been highlighting as a place where, despite the slowing of the economy, there could be a more friendly policy approach, and the equity valuations are quite inexpensive, so about 12 times earnings in China currently. And then the other 2 EMs to round it out, I'd say, would be Russia and Mexico. Russia clearly with a lot of perhaps political risks around it, but again, very inexpensive valuations and very well positioned for higher oil prices. And Mexico as well, with the domestic economy turning on, yet still quite inexpensive valuations, particularly in the banks. Those would be the opportunities right now that we're quite focused on, in a way, quite tactically. Again, I would just underscore India as being an important opportunity when we think about the next 1 to 2 years.
Well, Caesar, always a pleasure speaking with you. Thank you so much for taking the time out and speaking to CNBC-TV18. Have a great 2022. Well, that's the word coming in from Goldman Sachs, but don't go anywhere. When we come back, we will get another big voice. Mixo Das will be with us of JP Morgan to talk about what to expect from the union budget and how to approach this overarching theme, which is rising global inflation and the impact it will have on Indian markets. Stay tuned.
What the world wants.